Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and welcome to the June version of the FX webinar. Well, quite a lot has changed since the May one, and the biggest one of those is, of course, the announcement of the general election, which is due to be held on the 4th of July. So in my slide deck, I will be talking a little bit about that, but we're going to follow the same format that we normally do. So we'll have a look at the UK's economic outlook in the global world environment. We'll look at inflation and developments there, what that means for interest rates in terms of what the markets are expecting and what we're expecting. Then we'll turn our attention to politics, followed by some FX market forecasts. And of course, at the end is the disclaimer slide. But let's jump right into it in terms of the first slide. And the thing to note here is that the IMF have done the same as they did last year, and that they have had to issue a modest upgrade to the UK. Now, last year it was actually a very large upgrade, and this year it's moved the 2024 number from 0.5 to 0.7. That growth that we're seeing in the UK is predominantly, I think, because the numbers that we saw from the first quarter have come in stronger than expected, and that's what's prompted the upgrade to UK growth for 2024. They've left 2025 alone, but you can see versus January at least, the numbers were better, and versus the April figure as well, which is what the UK numbers relate to, there has been that small upgrade to 2024. You've seen an improvement in the outlook for the US, an improvement in the outlook for other economies, India, for example, and a slight upgrade to 2024 for global growth since January. The UK is still a marginal outlier. It's still towards the bottom end of the pack, but it's much closer now to Euroland and Japan in terms of rates of economic growth for 2024. One other thing that I think will have altered the IMF's thinking is how strong or how robust the US economy still appears to be. Going into the sort of final month before the end of the first half of the year, the US economy does appear to have outperformed versus expectations. Some of that, I think, is down to expectations that the Federal Reserve would cut interest rates more quickly than they appear now to be willing to sanction. So consequently, I think the second half of 2024 might be more of a struggle for the US, and we've certainly seen evidence of that in recent data and survey releases. So if we move on to the next slide and we look at inflation, what's going on here? Well, I mean, it's more of the same, really. You've still seen this stalling in progress as far as US inflation is concerned. A big fall in UK headline inflation, much less of a fall in the core inflation measure for the UK, and a virtual stagnation in progress as far as the services inflation figure is concerned for the UK, which is one element that has been raised repeatedly by the Bank of England as reason for them to hold back from reducing interest rates. So inflation rates are still overshooting, but in the UK, in Euroland, and also in the US, we are getting closer to levels where I think the central banks would be willing to sanction monetary policy loosening. That said, the timetable that I've talked about previously remains broadly similar. So Euroland, the European Central Bank, expected to cut on Thursday by 25 basis points. The Bank of England now might wait until September or even November before sanctioning their first interest rate cut, according to market expectations. I still think there's a reasonable chance that they cut in August, given how poorly the UK economy appears to be performing even after that bounce back that we saw in the first quarter. I think there's enough wiggle room now for the central bank to be looking at sanctioning interest rate cuts. And as far as the US is concerned, I still think we're looking at 2 rate cuts from the US this year. albeit that they will come towards the very end of this year. So either 225 basis point cuts at their last two meetings, or 150 basis point cut, either at their last but one meeting or their final meeting of the year. So sanctioning monetary loosening is still on the agenda as far as central banks are concerned, albeit that inflation has been overshooting recently, and there have been some concerns about the resurgence of shipping costs and some rises that we've seen in materials costs. I would note that if we look at energy prices remain subdued, and for the UK inflation index, I'd expect energy to have another negative effect, another lead the inflation rate down further when we get the July energy price cap revision. So look for that in the coming months. That could be another reason why we'd expect to see inflation falling to or below the 2% target on a headline basis. If we look at the next slide and we look at interest rates, as I say, the big thing to pull out here is really that Bank of England is now only predicted around 40% to be cutting interest rates in August. So that's been a significant reduction in rate cut expectations from the financial markets. Nothing really to prevent the European Central Bank from cutting interest rates on Thursday. And the Fed's delay, I don't think that will be altered materially unless there was a very sharp deterioration in the economic data over the next month or so, and I wouldn't anticipate that. There's also going to be a lot of focus on geopolitical and political factors, and the longer that we go through this year without any interest rate cuts from the US, the more that things like the US presidential election will start to feature as a potential factor preventing rate cuts from the Federal Reserve. But if the Federal Reserve delay, then I think that brings about potential downside risks to growth in 2025. It certainly reduces any domestic inflation pressures that we're likely to see in the US or the UK or indeed in Euroland. So delays now will have consequences in terms of future years and inflationary pressures from a domestic angle, at least, that we're likely to see. So if we turn our attention to the next slide and politics, big sort of update here from the US election was that Donald Trump got convicted on 34 counts of falsifying business records recently in New York. But according to his campaign team, since that point, he's raised more than $200 million in additional donations for his campaign. I find that absolutely staggering. I mean, even if 50% of that is true, then that is a staggering number for Trump to have raised. And I think the other thing to note is it doesn't appear to have harmed him particularly in the polls. So polling data remains tight, and it's notable that RFK Jr. Still holds around about a 10% vote share and potential vote swing that could turn the election one way or another. So he could end up being kingmaker in terms of he could decide, or the votes that are given to him could end up deciding the outcome of this election. So it'll be interesting to see whether he persists in this race throughout the remainder of the race, or whether he drops out at a later point. The other interesting thing about the US elections is that clearly, and this links back to the last slide, clearly the prospects of interest rate cuts have faded. I think that will undermine the chances of a material improvement in the US economy heading into that November 5th election. If we look at the right-hand side of this chart and look at the UK election timeline, tried to put in as much here as possible, much detail as possible. So on the 22nd of May, Rishi Sunak called the general election. There was then a prorogation of Parliament on the 24th of May, then an eventual dissolution of Parliament on the 30th of May, and we've already had the first debate. So we're already basically into towards the end of the first week of campaigning, and we've had our first debate. We're now expecting to see manifestos launched over the coming days, probably within the next couple of weeks. In Between that time, there is expected to be a Sky News leaders debate, but we've not seen yet any confirmation that will contain the likes of Rishi Sunak and Keir Starmer. You've then got other debates and other events scheduled before the polling day on the 4th of July, and we'd expect election results very late on the 4th of July and into the 5th of July. So we should get an outturn, an outcome for the UK election by around about sort of 7-8 o'clock on the 5th of July, probably actually a lot earlier. I think a lot of seats will have declared by the early hours, so it's certainly going to be quite a late night or early morning for many of us that are trying to analyze this. In terms of what this means for FX markets, the next slide says that we haven't really changed our views on FX markets. We have seen some tests of the highs recently in sterling dollar and euro dollar. That was more driven by negative events in the US. And interestingly, a lot of people put that down to a weak manufacturing ISM number when it was released on Monday. The reality of it was there was also a glitch in the New York Stock Exchange, and I think it was that probably had at least some impact on borrowing costs or on US Treasury yields, and also on the US dollar. I think it was those events rather than this spurious poor number from the US manufacturing ISM index that caused some of that dollar negativity. And I wouldn't be surprised if we see that reversed. In terms of other currencies, well, we've seen some pushback in dollar yen recently. We've seen again things like the Chinese renminbi remaining under pressure, and we have seen weakness in the South African rand since the South African elections, because we're still not sure about how things will go there in terms of forming an alliance with another political party. They can't govern on their own. So that potentially changes our thoughts on the South African rand and puts some potential weakness into that currency that isn't held within these current forecasts. And as far as the Chinese currency is concerned, I think there are still a lot of economic problems that could materialize for China and could weaken the Chinese renminbi going forward. So that's really it as far as my presentation is concerned. I think in terms of the final slide, that's my disclaimer. You're going to see a lot more of the disclaimer when Piers finishes his piece, but I'll hand over to him now so that we can have a look at how the technical analysis side of the market equation has altered since the last May FX webinar. Piers, over to you.
Thanks very much, Neil. Some of those forecasts seem to have changed quite a bit, Neil, from last month from the NatWest market forecast. Sterling dollar and dollar yen look quite different, I thought. But anyway, maybe that's just my imagination. But anyway, from the chart point of view, same charts as last month we're going to start on because they've worked quite well. The first slide, this shows dollar index. Dollar index leads the FX markets. Dollar is the main trade currency. So knowing what the dollar index is doing, very important. So this shows where the trend line comes from. And last month, I said that price had been retesting the trend line, and that's now resistance. And I was saying you could see maybe it fall off that area and go down to test towards the 23.6 and the Bollinger Band area. So sort of, I was looking for a move potentially down to the low 104, high 103 area. And if we go to the next slide, I've zoomed in and you can see price did fall off that trend line. We have come down, and what's price using as support? That 20-period moving average at the 103.90 area, and last month 104 sort of held it. So that's where support is at the moment. So it's sort of steady as a beating drum here. So what are we going to watch from now? Well, it's that 103.90 area is going to be key this month, because if price starts to break below that, then it does open that bigger move where I was saying we could see price go even lower down. So if you want to see a stronger dollar, you want to see the 103.90 area holding this month. Any move below the 103.90 area probably opens up a move down down towards 103, 103.05.15 area is the next area of support. Now, we know where the downside is, but what about the upside? Now, on the upside, I think we can lower the resistance. So I would watch 105.70 this month. If you start to see the dollar index above 105.70, that shows some strength coming back to the dollar. Rallies up to 105.70 could just be two-way trading, but above 105.70 starts to suggest change maybe on the monthly chart and maybe some interest coming back into the dollar and that 20-period moving average holding. So we must always remember with charts that the world is changing and we must change with it. So that's how I see the dollar index at the moment. Let's move on now to euro dollar. So this chart here is the one I start with, which is the quarterly one. And I like this chart, and I will do quarterly charts next month, but this just puts big picture perspective. We broke below that trend line, we went back up, and it's been resistance. Price has fallen off, but it hasn't really broken away and collapsed off. But that's the area you need to see euro dollar above if you're a euro dollar bull and you think euro dollar is going higher. But let's just look at the next chart and slide in a bit to the more current price action. So last month I said we've been watching the Bollinger Bands and we can see that price is back down testing that as support along with the 38.2% area, which was 106.12. So I said if the euro dollar bulls are going to attack higher, they need to rally off that area like they have over the last year. Then their battle will be with the 109.50, 112.75 area. And all it takes is faith and trust, as last month that played out really well. Price rallied out that 106.40 area on that chart, so that 20-period moving average held. Where did price go up to? It went up to just below that 109.50. We had a high around 109.20. So just below the base of that 109.50, 112.75 from last month we talked about. So the levels are working, and we've just got to keep watching those. We start this month with initial monthly resistance in the 109.40.75 area. That's the area that's capping euro dollar at this stage. And it needs to break above that, and that would open the 110.30.60 area as the next resistance, with the main resistance still being that 112.75. So that comes in line with the trend line. So that would be a big area if it does get back up there. Where is support? So support this month should be in the 108.20.30 area to start with, just as initial support, with stronger support around about 107.80, below which the attack on that resistance is starting to fail, and it reopened that 106.10.50 area as the monthly support. Now, this is the monthly chart, just sort of showing what's happened each month. Next month on the webinar, I'll look at the quarterly chart, and that will give the outlook, hopefully, for the next few months coming out. And so it'll be important to see where price closes this month in relation to that quarterly chart. So one to keep an eye on. So that's euro dollar, the key levels just to watch at the moment. And then if we go on to the next chart, we have the sterling index. So it's one of my favorites. It's good to see you again, my old friend, this chart. As last month on this chart, I said the 64.90, 65.25 area should be support on pullbacks, with 67 area, use it as a pivot between that support and 69.70 area, where the stronger resistance lies. Nothing's really happened to change my view on the sterling index at the moment. So, well, no, listen, that's not what I meant. Let me explain. Not as much has changed, because resistance is still around that 68.70, 69 area. It was a slightly negative month last month, and that's the thing we've got to be careful of here. Is that going to be like a little hanging man hanging on sterling there? So we haven't really changed much on sterling. I've watched the same levels. The only thing predictable about life is its unpredictability. So at the moment, you've got the UK election, and that hasn't caused any real change. So the levels are still the same to watch, because the potential expected outcome that's been factored in has sort of not had any impact, because everyone thinks it's a foregone conclusion. But you have to be vigilant here, because there could be a shock if anything comes that changes that perception. And, you know, the UK electorate's been told you must choose your own path, And now we have to wait and see how they vote and what path they choose. So for euro sterling, I'd still use maybe the 67 area like a pivot. If it starts to go below 67, sterling's starting to weaken, maybe a bit of sign of weakness. If it can hold above 67, sterling's holding its own, with the stronger support round about 65 and the stronger resistance up at 69. So let's see, how does that play into the actual currencies? So this is euro sterling, and this month I'm going to do euro sterling because sterling euro sort of works on the charts, but sterling euro sterling works perfectly. So this is to show the whole retracement and the trend line, where the trend line comes. And then if we go to the next slide, we can look at this and say, you know, last month I said the main thing was the break of the long-term trend line. And while price stays below that, that could put pressure on support, initially in the 84.60, 85.30 area, with the key support below that being the 84.38.2%. I said only above 87.50 does that negative risk sort of go. Now, we saw a retest to that trend line. If you look at last month, this is how the charts can really help you if you have currencies to hedge. Look where the high was. The high was right on that trend line. So the market went to that, rallied back up to the trend line. And what happened there? The market just sold off and it fell down and had a negative close. So that's another session under the trend line. So it might sound boring stuff, but I think the boring stuff I remember the most, and I am self-taught. So I just think it's worth remembering that trend line. So where does support? Support this month starts in the 85 area, followed by 84, 55, 60. And below that is that key 84. So those are the support areas. Monthly resistance is up at 86.10.20. And only above 86.65 on a monthly close has this shaken off the downward pressure of breaking below that trend line. Now, we had that election coming up, so things might change. But at the moment, that 86.40, 86.65, while you're below that, pressure should be on the downside. So if we go to the next slides, this is sterling euro. So this is sterling euro the other way round to euro sterling, and it's got the levels, if you like it, on a sterling euro basis. And then we go to the next slide. I've zoomed in again there, and you can see how that 20 period moving average is holding. You've got that sort of 115.70, 116.25 area acting as support, and maybe 118.5 area. It starts to get up there, might find it a bit troublesome. But keep an eye. I think the euro sterling levels to me are working better. You're better to transpose them than try and look at the sterling euro levels. So finally, I'm going to finish up on sterling dollar. And on the first chart here, we can see both the high and the low since 2021, and thus put on the Fibonacci retracements of the move lower from 142.50 area 3 years ago down to the 103 lows 2 years ago. It's practically perfect in every way. And as at the start of last month on the webinar, I said the markets used them well this year. And for the past 6 months, price has been capped by that 61.8% area. Now, that carried on this month. We've still seen that cap it. But one point I did highlight last month, and I put it in yellow, highlighted out, very much what's the 123, 124 area as support on the monthly charts, above which the pressure stays on that downtrend line. So if we move into the next chart, you'll see that a bit clearer. So this is what I was warning about last month, the pressure being on that downtrend line. And what's happened? We've got above that downtrend line. So we've broken above the downtrend line, but price hasn't rallied much away because it's still got that 61.8% in the 127.60 area. So what do we know here? We know where the support is. The support is that 20 period moving average. Look at the last 2 months. That's been the low. It's rallied off there. It's pushed through to the trend line. That's all slightly positive, but you're just capped by that 61.8%. And above that, you do have the Ichimoku cloud, that yellow bit, you know, clouds, strange clouds. I know some people sort of say that, but it does work well as support and resistance. Look where price has fallen off the last few times. It's fallen off the cloud. So you really need to see price through that cloud to be more confident of it going higher. Now, where would I put resistance this month? Initially at the 128.40.75 area, and we need to see progress through that to open the possibility of the 130 area. Where would be the big area for sterling dollar to get above in the next couple of months? 131.43. And why is that? That's the previous high. So we go back to last year, the high was 131.43, and that is important because so far you have an uptrend. You have higher highs and lower lows in this whole rally up since 2022. To keep that uptrend in place, you need to see a higher high. Otherwise, if it starts to back off that area and come back down and test it, the sterling dollar bulls might lose a bit of their strength. So I think watch those areas as resistance. Where is support? Well, support, as I said, was that 24.83. You should have initial support maybe in the 126.85 area, maybe 126.20. If it starts to get below 126.20, then it is starting to lose that impulsive positive feel it's had. So as I said on sterling before, the UK election hasn't really had any impact on this chart because the potential expected outcomes sort of factored into the price. But let me finish on the charts by saying sometimes you try your hardest, but things don't work out the way you want them to. So let's just see how it plays out. I'm beginning to sound like an economist here, Neil. Anyway, that's me finished. The next slide is the disclaimer. I hope that sort of made sense. But as I say, next month will be much more interesting because we'll have the quarterly charts.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.